derailing the gold bull market. In that case, there's nothing wrong with gold. There's something wrong with the investor.
Analysts are warning the market is sending signals we haven't seen since 2007, and some are even expecting a massive reset before a major cycle begins into the 2030s. Let's break down what's really going on. According to Warren Pice, gold, GLD, from record inflows to extreme outflows. Retail sentiment toward gold has normalized. Gold bottom for this correction is in or close. So Warren Pice is highlighting a pretty sharp swing in ETF flows, moving from huge inflows to now big outflows. That usually tells you retail enthusiasm cooled off fast. When he says sentiment has normalized, he's basically saying the emotional excess has been drained out of the market. And his point about the bottom being in or close isn't a forecast, it's more like reading crowd behavior. When people stop chasing, corrections often stabilize. Henrik Zeberg added, the real case for gold, massive pullback in gold into 2026 before the Fed's real intervention, and gold begins a massive rally into 2030s. But first, will we see BTC outperforming gold massively the coming weeks, months? So Henrik Zeberg is taking a long-cycle macro view. He's suggesting gold could see a deeper pullback going into 2026 before entering a structural uptrend into the 2030s, basically a multi-year thesis. And the interesting part is his comparison to Bitcoin, saying BTC could outperform gold in the very near term. This reflects the broader risk-on versus risk-off dynamic. Crypto usually reacts faster, gold reacts deeper but slower. The great Martis wrote, Gold, 2007 versus 2025. Gold is warning. Is its warning about to get a lot louder? Here, the great Martis is drawing a historical parallel, 2007 versus what he sees forming into 2025. When he says gold is warning, he's suggesting the price action is signaling macro stress or liquidity tightening, similar to what gold often does ahead of systemic events. He leaves it open-ended by asking whether that warning gets louder, which is a typical way analysts express uncertainty without making predictions. Another post from the great Martis wrote, Gold, inverted chart, offers a different perspective, and IMO solidifies that a big continuation pattern is in play. This one is classic technical analysis thinking. An inverted chart basically flips the narrative. It lets you view price structure from a different angle. When he says it solidifies a continuation pattern, he's stating that the long-term trend might still be intact despite short-term volatility. It's a visual argument, not a directional call. Jordan Roy posted, the gold bull market is not 10 years old. It's like saying the stock bull market in 1983 was 9 years old. The complete underallocation to gold confirms this, as well as other indicators of gold in real terms. Jordan Roy is pushing back on the idea that gold's bull market is mature. He's comparing it to early 80s equities, basically saying the major phase hadn't even started yet. The key phrase is underallocation, meaning investors still don't hold much gold relative to other assets. That's usually used as an argument that sentiment hasn't reached what you would expect in a late-stage bull market. All right, here's a quick clip from Rick Rule. Listen up. He breaks down why that gold pullback wasn't weakness at all.
Gold has actually rebounded. Let's start there. Gold is back to around $4,200 an ounce, $4,164 to be precise.
Right.
What triggered the rebound? What is your sort of estimate here?
Well, as we discussed in New Orleans, I think the gold price over the course of a decade will do well, but gold went too far too fast. I also think that people's reaction to the decline was naive. One needs to ask oneself, did the gold price fall by 7%, or was it up by 100%? You'll recall that in 2023, the gold price was half of what it is today. I think that people have a myopic focus around time. In my experience, Kai, people who have problem with a 7% decline should find a different sector.
No.
I think that they have a decade of good markets in front of them. But I suspect that 2 or 3 times in the course of the next decade that the gold price will fall by 25% or more without derailing the gold bull market. In that case, there's nothing wrong with gold. There's something wrong with the investor.
Gold bounced back to around $4,164 to $4,200 an ounce, and the rebound isn't random. According to Rule, the recent drop didn't signal weakness. It was just a normal correction after a huge run-up. His main idea is that investors often zoom in too much on short-term moves and forget the bigger picture. He points out that gold was almost half this price in 2023, so stressing over a 7% pullback misses the context. In his view, if someone can't tolerate these routine dips, they might not be suited for the gold sector at all. Rule is basically reminding people that a long-term trend can still be healthy even if there are moments where the price drops sharply. He also mentions that even within a strong decade-long market, we should expect multiple drops of 25% or more, and those declines don't necessarily mean the bull market is over. That's just how commodities behave. They move in big swings. The key takeaway: gold's volatility doesn't automatically signal trouble. Sometimes the problem isn't the asset, it's unrealistic investor expectations. This video is for informational and educational purposes only. Nothing in this video is financial advice, investment advice, or a recommendation to buy or sell any asset. Always do your own research and make decisions based on your personal financial situation.